Hi guys, welcome to today's video. Today we're going to be talking about trading psychology and how I managed to keep my psychology in check, because there is a whole process in which I believe one should do to make sure that their psychology is in the right state, so they can experience some consistency in trading. So we're gonna get into trading psychology. We're gonna get into the other things that go along with trading psychology, and yeah, stay tuned.
Those who made it.
Well, when it comes to psychology, I believe there are three things in which you must find a balance and some sort of synchronization between the three. And I'm gonna get straight into them. The first is strategy. Of course, everyone has to get there, and everyone has to start there, really.
I know those who made it.
And it's one's responsibility to find a strategy, not just a strategy, but a strategy that works, and a strategy that is clearly profitable, right? Whether you find it for yourself or you find it through mentorship, regardless, find it through a book, a video, I don't know, and whatever the case may be. But you have to find a strategy that works, and one of the best ways to validate that a strategy works is by backtesting it. And backtesting comes with a ton of benefits, and there are many ways to backtest. You can backtest using the traditional way of opening your MT4 or MT5 and just looking at the setups manually, or you can use the TradingView software, pay for the membership. I think it's I can't remember what its membership per month is, but there is a premium that you pay, and there's specific features that come out with TradingView, and one of which is that playback feature where you can backtest your strategies and where you would enter or exit and stuff of that nature. Or you can use the traditional way or any other way just to backtest and see for yourself whether or not this strategy works. One of the best things that I do is I go back maybe 1 year or maybe 2 years worth of data, and I look at the setups in which I would go for, right? The kind of setups I would enter, and I would literally write down the setup, the date, the setup, the date, and I would also, well, where's my notebook? Yeah, the setup, the date, the setup, it's the date, and also whether or not it was a high probability setup or just a valid setup or just a random setup out of nowhere. And I write down whether that setup actually worked or not, because some setups they can how can I put it, some setups can come along and they will validate your strategy and your approach and whatever the case may be, but they don't go your way. Maybe market manipulation, maybe breaking of the structure, maybe expanding, or maybe evolving into a different structure, whatever the case may be, right? So I would write it down, and then over that period, maybe a year, maybe 2 years, I'd write down those setups, the ones that worked, the ones that didn't, and what I would do is I would make a calculation of how many times, or what are the probabilities of my TP getting hit, my take profit getting hit. And so maybe perhaps there's a 60% chance out of all the setups that I saw in the data that I saw in the MT4, maybe 60% of them hit TP or 70% of them hit TP. And sometimes I would go into details, like even in the month of July 2021, this is how my strategy worked, or played out, or whatever the case may be. In September, this is what happened, and in December, this is what happened. So backtesting gives you some sort of a mental validation that this strategy works, right? It gives you confidence to use the strategy after all. The second is your risk management. Now it gets tricky because risk management it depends, in my opinion, it depends on the strategy in which you're using. That's just my personal opinion. The risk management for example, the risk management for a fundamental trader will not be the same as a risk management for a sentimental trader, or the risk management for a sentimental trader will not be the same for a technical trader, right? Even in the technical side, the risk management of a swing trader will not be the same as the risk management of a day trader, for example, right? So you must find a strategy, or rather a risk management plan that goes along with the strategy in which you're using. If it's justifiable for you to risk 5% at a time, do it, right? If it's justifiable for you to risk 10% at a time, 10% per trade, do it. If you see fit for your strategy to risk that much, go ahead. If it suits you, and it suits your strategy, and it suits yourself, which we're gonna get into in the next segment, trust me, you have each and every right to do it. Do not hesitate, do it. Yes, and also risk management is not just the money in which you're gonna lose, but the money in which you're gonna gain. Sometimes going through the backtesting stage, or yes, backtesting your strategy, you see over time, over the period of a year or over the period of 2 years, you see where and when to place your stop losses. What is a justifiable place to put your stop loss? What is a justifiable place to put your take profits? And also what can then you can go into what kind of a lot size you want to lose, what kind of a lot size you want to use, and all that good stuff. But all these things also come as a result of backtesting. That's why I say there is a synchronization between the two, and you must find a correlation, some sort of a balance between these two things. And then the third, and probably the most important, is your trading psychology. Now, here's my humble opinion. If you disagree, feel free to disagree, right? But in my humblest of opinions, your trading psychology boils down to two emotions, right? It all boils down to two emotions, that being fear and the other being greed. Now you can break it down into the fear of missing out, the fear of losses, or on the other side you can break it down to I don't know, all these kinds of emotions that fall under greed, that being revenge trading, or whatever the case may be, right? But at the end of the day, there are two main emotions when it comes to forex trading as a whole, that being fear and greed. Now, it's always a good idea not to lean on any side of of these two main emotions, right? It's always a good idea to find a neutral ground between the two. not to lean on the fearful side, not to be too fearful when you're trading, and also not to be too greedy when you're trading. Like I said, it's always a good idea to backtest your strategy and find a risk management plan that is justifiable, or rather that is in sync. I believe, right, once you find over time, once you find a strategy that works and you find a risk management plan that also works with the strategy, and you learn to discipline yourself to stick to that risk management plan. If you told yourself, according to my strategy, it's always a good idea to risk 5% per trade, and you do yourself that favor to stick to that 5% per trade, right? Let's imagine that 5% per trade is not it's not being fearful, to lose, but also it's not too greedy to gain too much. Then I believe if you stick to that alone, I believe your trading psychology will take care of itself, because now you've done your work, you've backtested it, you've backtested your strategy, you found a risk management plan that goes along with your strategy, and now all you have to do is just be disciplined and be repetitive with placing your trades and remaining disciplined to that 5% per trade or 1% per trade, or whatever works for you. What works for you might not work for me. What works for me might not work for the next person, right? So that I believe is a very important tip. So just to give a little bit of a recap, the first and foremost, again, strategy. Backtest your strategy, find a strategy that works for that mental validation, or this strategy works. And then the second thing, to find a risk management plan, not to find it, but develop a risk management plan that works perfectly, not perfectly, but that works, that is befitting to the strategy at hand. And then be disciplined when it comes to following the rules of engagement, when it comes to your trading plan, or rather your strategy, and also being very disciplined when it comes to your risk management plan. I believe when you do that, your trading psychology takes care of itself. You are going to be emotional over time. When you experience consistent losses, you are going to be emotional. Perhaps you're going to be on the fearful side. You're going to want to risk a little bit less, or you're going to be on the greedy side. You want to pay revenge. You want to make your losses back by overlord sizing, or whatever the case may be. Please, I beg you, please avoid that by all means. Do not fall for that trap. It is not worth it. Trust me, I should know. I've been trading from 2017. I should know that it won't get you anywhere. So be disciplined with that. And also, a last and final tip that I believe would help a lot of you guys. Try your utmost best, right? Try your utmost best to trade using money that you don't mind losing. I'll explain. If, for example, you're a student, I can imagine you're a student, or you're working, or whatever the case may be, it's never ever never a good idea to deposit the money in which you need to perhaps pay for your rent, to perhaps pay for your groceries. If you're a student, it's never a good idea to fund using money that is supposed to be going to your tuition fees or your groceries, or whatever the case may be. If you're a working person, the money in which you're going to use for your petrol, or your car for your car, or whatever the case may be, do not trade using money that you don't, that you mind losing. right? So for example, if you have maybe 10,000 to spare, right, and you decide, you know what, I'm gonna trade using 10,000, I'm gonna risk 10,000, instead of depositing the entire 10,000 rands, why don't you deposit 1,000 rand and then flip it to 2,000 and withdraw, you know, deposit, and repeat the same thing. Take maybe 1,000, flip it to 2,000, 3,000, 4,000, withdraw, and build capital that way, rather than to deposit the whole 10,000 rands and there you are risking, I don't know, 10% of that at a time. Obviously your psychology is not going to be well, you're not going to be thinking straight, you're already attached to that money. So one of the best trading psychology tips that I can give you is to detach yourself from the money in which you're depositing and trade using money that you don't mind losing at all. Otherwise you're not gonna be thinking straight. Trust me, I should know. You're not gonna be thinking straight. You're already attached to this money. You already have obligations with this money. You're supposed to be paying your rent or whatever, and here you are taking risks with this money in which you're supposed to be paying rent with. So to avoid such, use or rather trade using money that you don't mind losing.